Hi, just want to review round four results before everybody moves on to the next round. And by and large, most companies got close to 400 or over 400 points is what we're kind of shooting for. And although four companies are having trouble, so I'll discuss some things that some commonalities, some companies, some mistakes companies are making. So to explain why maybe didn't earn the average points for this round. One of the biggest things is profit margins. Everybody started out at 40% profit margins, and by round four should be in the 50s or 60% profit margin area. Here we only have about half the class in that area, and the rest of the half the class hasn't made much progress in improving their profit margins. And some four teams are below the 40% profit margin they started with round one. So if you've had 4 years to work on your profit margins, and you started in year zero starting at 40%, and your company hasn't been able to get above 40%, that's why you're disappointing investors, and that's why you're losing points. Now, people who are in the 40 percentile gross profit margins, that is too low. You're not optimizing your company, you're not maximizing your profits. You have to lower costs, increase prices. A good way to lower costs is to invest in operational investments, because not only does that earn you points, it also helps generate cost reductions. Of course, if you lower your customer your features on your cars, that may disappoint some customers, but it will lower your costs and increase your profits. And raising prices is pretty self-explanatory. Okay, so stock price pretty much follows suit with profits. So the companies that are profitable are in the $70 to $90 range of profits. Companies that are less profitable or haven't been making a lot of gains in their profit area are falling below $60. And again, investors don't like that, and your year-over-year results will be lower. Okay, so return on equity is a reflection of your earnings. So high earnings get higher return on equity, low earnings get lower return on equity and equal lower points. So in the total point category, all these teams are about 1,800 and above have a really good chance of getting the points needed to earn the full points of this project. Teams below still have a chance to catch up, but may have trouble getting the full points of this project. And those points are detailed under assignments, or I think they're in the assignment area. Okay, so operating profit margins. Let's see, down here, operating profit margins. This is a reflection of how efficient your marketing is. So marketing is part of operations. If you overspend on marketing, and you can check this by looking at your market potential. If your market potential is much higher than the cars you're actually selling, you may be over marketing, and that would just be wasteful, and you could trim your marketing budget somewhat and hopefully increase your operating profit margins. And of course, earnings per share are a reflection of your net profits, and you can see how some companies at the 14, you should be close to over $10 by this round. If you're below that, your earnings are not at industry average or above. And you can see that everybody starts out the same position, has the same opportunities. It's the efficiencies of your strategy and your operations that help to increase your earnings, and most importantly, your profit margins. Okay, return on assets is profits in relationship to the amount of assets you have. If you create too many assets that aren't producing profits, such as operational plants that you don't need, or things like that, or leftover inventory, cars you didn't sell, or assets. Inventory is an asset. You're going to have a lower return on inventory. So the more efficient you are with your assets, the higher the score will be. Of course, net profit margin, you should be around 20% or higher, and this is after the costs of interest and on your business and such. It's the bottom line. Revenues per share should be above 50 by this point. And total asset turnover, looking at your assets in relation to sales, should be high. That means you're getting the maximum amount of sales out of your assets. Okay, so those are just some commonalities I see when I'm going. So I'm going to go into my demo, and the first thing I see with some students is that their cars, when they make their cars, they aren't beating last year's profit margin. So you need to check what my profit margin here was at 40% and 60% gross. And then when I go into sales, I need to make sure that when I make my vehicles that I'm beating that 60%. So here I'm beating it 68. One reason I'm beating it is that I have a lot of operational cost reductions. So I've made those investments to help me better track my sales. Now, when it comes to the forecast, I don't want to work with last year's sales. I want to go to charts, and I want to go to performance charts, and I want to see at the bottom here. Okay, so sedan, this was actually my potential, but when I forecast, this is economy rather, so I can use that number. When I forecast sales in sedan, I don't want to increase this number. I want to increase this number, 53, because this is my actual last year potential. So I want to grow. If this market is growing at 20%, I want to increase the 5,300. Same thing with truck, and same thing with luxury. Luxury, I could probably sell 5,000 based on this number, but if I went by this number, maybe I would only forecast 4,000. So that's why you need to know what your potential is, so you have a better idea of where your forecast lies. Okay. So this grows pretty fast. I want to put that up to 5. Let's see what profit margin I could get. Okay, 70% profit margin, very good. And I'm going to put this up to 6 based on what I saw in my potential. Okay, so this is just kind of above 60, so not much progress here. So I'm going to actually make a car that's not so great. However, this car, I'm not going to forecast as aggressively, so I should be able to sell what I forecast and beat my profit margin. So it's a trade-off. I'm making a trade-off. I'm voluntarily reducing my sales because I'm making a car that's not meeting customer expectations, and I'm okay with that because I need to make my profit margin. So maybe I won't sell as many cars as I potentially could, but at least I will be more profitable. Okay, so here I'm trying to get to 70%. Okay, so now I've beaten all my profit margins, some of them by 10%. All right, so advertising I'm going to skip because it takes a long time and it involves, so I'm going to do that offline. Production is another area where I see people making mistakes. Some teams are buying more production plants. See, I need a total capacity of 6,000, so I'd buy 2. But some teams go and say, oh, I'm going to buy 5. Now you have all these assets, all these production plants set up. No one's working in these no one's producing any cars in these production plants. You're not selling anything from these production plants, and you're not making any profits. So it's just that's bad at buying assets that aren't utilized. So make sure that you only have as much. Only buy as many plants as you need. Now I see a lot of teams, purposely having, excess capacity here. Don't do that. Make it 0. It should never be. I see a lot of teams putting the 200 in there, so they keep 200 excess. Don't. If you think you're going to sell another 200, forecast that so it's reflected on your pro forma financial statement. Having production, just basically production deciding to make 200 extra cars, no one told them to, and then sales and marketing and finance have never planned on this, have never marketed or planned to sell those extra 200 cars, and then those cars aren't sold, and you're left with an inventory that is dragging down your asset ratios. So don't try and have any excess or shortage. I've seen 3 teams do that. Just build exactly what you think you're going to sell. Don't try to build extra, or don't have a shortage either. So make sure that your forecast matches what your inventory and production is. Otherwise, your production is doing things that they're not communicating, that they're building extra cars to marketing so they have a chance to market more heavily, or to sales. And the financial people don't realize these cars are being built, and then they're not reflected in the pro forma financial statements. So very important that you build what you're asked to build. Okay. And again, even though it may be one of the last rounds we're working on, that doesn't mean you shouldn't make operational investments, because you still earn points for making operational investments. Okay, so let's see. So I have a lot of excess cash. So since I have some excess cash, I'm going to go back to production, and why not? I'm going to increase my operational investments since I have the extra money. There's no point in letting that sit still. All right. And I guess I will pay down stock, buy back some stock if I have excess cash, buy down some debt. Now there are limits to what I could buy down, because I guess in the notes that I issued, there's a payback clause of how much I can pay back each round, but I'll pay back what I can, because this will, and I don't want to pay back everything anyway, because then I'll never be able to improve those ratios in previous round and earn even more points. So kind of paying back things at a reasonable rate helps to maximize points. Okay, so I've done everything possible, and I still have a large surplus, but at this point I'm not going to be spending it on marketing and wasting it. It's sort of like having a small deli on Long Island, but spending $1 million to advertise in the Super Bowl. It's just not worth it. So I think my advertising is maximized. So I'm not going to, advertise extra just because I have extra money. I'm just going to leave the big surplus at this point. Okay, so I feel like I've done everything I can do to increase prices, reduce costs, and increase my profitability. So I have a good pro forma financial statement. It looks like I'm going to make money, so I'm going to process the round. It's the individual practice. And there, I made 500 points. How did I make those 500 points in this last round? One, I got my profit margins higher. So my profit margins, I got each car higher than last year's average. I got my operating profit margins higher, and my net, and these higher, and I got my sales higher, because I looked at my demand and increased off my demand. I got my my debt ratios. I earned points because I paid down debt. I earned points because I increased my profit margins. I earned points because my increased profits increased my earnings per share. Return on equity reflected it. Return on assets reflected it. I increased my market capitalization because my stock price went up. My book value went up because I created more assets than liabilities. And my forecast was accurate. So you never really earn a lot of points on forecasts. Just try not to lose them. I invested as much as I could in operational investments, so I would make some points. I couldn't make the full 100 because I didn't have enough room. But 500 is a really decent score for that last round. Okay, so I hope that this has been helpful. And I can see that the teams that have been watching these videos and listening to my suggestions have been doing better. The teams that are still not increasing their profit margins or making some common mistakes, I just get the feeling that they're not watching these videos to the end and getting the full help they can, which is, take all the help you can get on this. So you have one more round to complete, and I'm pretty confident most teams will make the full score they need to get the full points for this assignment. So good luck, and talk to you soon.